In this video, I will explain how to initiate and execute a cover call options strategy to generate a stream of income. And for better understanding, I will discuss the component of cover calls: the what, who, how, why, and when. Thereafter, in another episode, I will demonstrate the process using options chain table to exercise cover call. And please check my previous videos on the same topic at the end of this clip. This is more of interactive episode, and I may repeat myself all along for the sake of clarity. Welcome to my channel. Please subscribe and thanks. Watch till the end because there's a promotion towards the end of this clip. What is cover call? Simple. A cover call is popular option strategy used to generate income in the form of premiums. So when do you use this strategy? If, for instance, as an investor, you intend to hold your stocks, say AT&T, for a long time, meanwhile you do not expect an appreciable price increase in the near term, then you can use this strategy to generate additional incomes known as premium during the time when the stock is consolidating or moving sideways, if you like. Meaning, a cover call can be regarded as a short-term edge on the long stock positions. Cover call component. You must at least own 100 shares of any stocks, selling one call option against the shares that you own. Meaning you must or should have at least 100 shares of stock for every one call option that you sell for you to achieve a proper cover call position. Let me break it down further. Let's assume you own 100 shares of AT&T in your portfolio, trading at $29.29 per share. So multiply your 100 shares by 29.29 equals $2,929, represent the current value of your shares. And at the current value of 29 per share, you notice that the price has been consolidating for some time. Though you know that in a long term, AT&T will appreciate. Meanwhile, you decide to initiate and sell one contract of AT&T August 49 call at $1.94. Note, this is just for illustration. Figure may be different on the option chain table. Again, you want to sell cover call against your AT&T shares. And you should remember, you always sell option to say about 30 days to expiration. And you want it to expire as quickly as possible. Thereafter, you should look for a more suitable strike price, and choosing the strike price is up to you. Meanwhile, let us look at AT&T chart and use technical analysis to examine our various possibilities. Looking at the chart, you will realize that there is a strong resistance at, say, 31.12. Again, as you sell the call, it is reasonable to sell it out of the money with the hope to realize gain quickly. And you could sell the 31.21 thereabout at this resistance, or you could do the 30. You could sell the 32 call. However, with the 32 call, you are much safer, unlike the 31.21 call, which is much closer. Here's the key: when you sell the call that is much too far out of the money, you will collect less premium. And if you sell, say for instance, call close to the current price, you will receive reasonable premium. Again, it could reach the strike price much faster. So you should decide what you are more comfortable with. Please watch my next series when I shall illustrate in details using option chain table. Again, you should remember one of the key components of exercising a cover call option is that you must at least own 100 shares of any stocks. And if you do not own 100 shares in your portfolio and you go ahead and execute the trade, this technique or strategy, if you like, is called naked call. And again, it is important to emphasize that a naked call seller is exposed to potential unlimited losses with a very limited upside potentials. Though many brokers should or will not allow naked call practices. Okay, let's say you are given the go ahead by a broker, for instance, and you initiate the naked call option. If and when the option expires worthless, you will be forced or you are obligated to buy the shares at the current market price and sell it at your strike price, since you do not have an underlying position. And before you initiate a cover call position on any company, remember warrant wisdom. Buy a business for less than the business intrinsic value with management of the highest integrity and ability. And of course, a company with a low debt and with a business mode. Okay, time for promotion. The channel need to get to 200 subscribers. If and when you tell your friends and family to subscribe, and please create a code, like say for instance Jonathan 7, and tell your friend to subscribe and write Jonathan 7. And if you have the highest number, say 100, and the rest will have say 20, 30 or less, you will get a headphone. The company will announce the winner, and I will send your prize through Royal Mail delivery system. Key takeaway: with cover call, you can create a stream of monthly income without much risk. Cover call can be used to hedge your stocks, thereby reduces loss of potential on share price. The strategy is very suitable for investors who believe the underlying stock will not move much higher in the near term. To execute a cover call strategy, the investor is better off to own the underlying stocks and for a long time. Okay, here comes the best part. Subscribe, comment below, and thanks. Remember, the goal is to generate wealth, build companies, and create jobs. Bye now. See you soon.